In this video, I will be revealing the most common RRSP withdrawal mistakes Canadians make and how these costly errors can derail retirement plans. Through working with countless Canadian clients who lost thousands due to poor withdrawal timing and coordination, I have discovered that understanding withdrawal strategies is essential to avoid leaving money on the table. That's exactly why I'm making this video today, to break down the withdrawal mistakes that trigger avoidable tax bills and show you how to ensure your RRSP withdrawals support your retirement plans rather than sabotage them. Let's get right into it. The withdrawal timing mistake that triggers massive tax bills. Well, first of all, let's start with the fact that there is no difference in taxation between the RRSP and a RIF. So when I'm referring to taxation of your RRSPs and strategies that are relating to RRSP tax planning, exactly the same rules, so exactly the same strategies refer to your RIF. And, we love our RRSPs when we're making contributions because every dollar that is contributed, as you know, to your RRSP is fully tax deductible. But these are tax deferred funds, meaning that once you start pulling funds out of the RRSP, it is any dollar amount that you pull out of your RRSP is fully taxable, 100% taxable as earned income, and it is taxed on top of your employment income if you're still working, or pension income, CPP, OAS, any rental income you might have, any investment income you might have in retirement. So therefore, you want to avoid pulling funds from your RRSP while you're still working full-time when you are in a fairly high tax bracket. The other fairly common situation is you should be avoiding pulling funds out of your RRSP in the final year of employment, when a lot of employees will receive unpaid vacation pay or potential various bonuses. And then you should go into your RRSP or RIF the year after when you are in a lower tax bracket, especially if you're retiring prior to the age of 65, before CPP and OAS kick in, because most likely those first few years in retirement will be your lowest tax years in retirement overall. And you should also consider going into your RRSPs, even if you do not need those funds to fund your retirement, just for tax planning, pull some funds, some additional funds out of your RRSP or out of your RIF, not necessarily to fund your retirement, but to move funds from high tax retirement into your TFSA, or if your TFSA is already maxed out, move funds into a non-registered portfolio, which would be much cheaper taxation-wise than your RRSP or RIF assets. Withdrawal timing creates tax problems, but the OAS clawback mistake shows how RRSP withdrawals can eliminate government benefits entirely. The OAS clawback mistake that eliminates government benefits. Old age security, or the OAS, is a major Canadian retirement benefit, and it is based on Canadian residency. So anybody who has 40 years of Canadian residency after the age of 18 would qualify for 100% OAS, and you can start receiving old age security at the age of 65. You could also defer to age of 70 and receive a deferral bonus. But to make things more complicated, the government has OAS clawback in place. And essentially what they're saying in the government's eyes, if your income is too high over a certain threshold, they will reduce or they will claw back your OAS benefit. And let's look at an example, a real quick example here. We have Clark, age 65, and we're assuming Clark's taxable income in 2024 was $110,000. The OAS threshold, so that's the threshold over which your OAS is being clawed back. Back in 2024, that threshold was $9,997. So in Clark's case, the excess income or the income over that threshold was $19,003, and 15% of that number is the actual OAS clawback. So in Clark's case, $237.54 per month would be clawed back because of poor planning. Your OAS will be fully eliminated at about $148,000. So it is a gradual reduction, as I said earlier. Based on 2024 income, OAS starts at about $91,000, fully eliminated $148,000. And when your OAS is fully eliminated, basically you are technically in a much higher tax bracket than you would have been otherwise. That is why it is very impractical to make large lump sum withdrawals from your RRSP or from a RIF, because after the age of 65, your OAS will be reduced or eliminated. As far as planning for retirement, it is crucial that you have other assets than your RSPs. Your TFSA should be hopefully fully funded or at least partially funded. And you should also have some non-registered funds in case you do need these large lump sum withdrawals, either to fund, let's say you need to fund your roof repair, or you need to fund a large vacation, or you would want to gift funds to your kids or grandkids. Large RSP withdrawals are impractical because of OAS clawback. That's why it's crucial to have a TFSA and or non-registered funds available transitioning into retirement. Now that you understand OAS clawback risks, if you need help optimizing your retirement plan, click the link below and I will show you how exactly to maximize your retirement strategy as a whole in Canada. The CPP coordination mistake that wastes retirement income optimization. CPP, or the Canada Pension Plan, is the main Canadian retirement benefit available to Canadians, and anybody who's working in Canada must be making contribution towards CPP via taxes withheld at source. You can start collecting CPP as young as age 60. Normal retirement age is age 65. You could defer CPP to age 70. Those are the basics. But it is a mistake, in our opinion, to start collecting CPP prior to the age of 65 because your benefit would be reduced by about 35% if you started collecting at the age of 60, and your benefit, CPP benefit, would be increased by about 42% if you were to defer to age 70. Now, this is a lifetime increase or lifetime reduction. CPP is also adjusted for inflation. So it is the main pillar of Canadian retirement system. But as I said earlier, a lot of Canadians will try to collect as early as possible. And again, we believe it is a mistake because even if you retire at the age of 60, you should be using your RSPs to fund your retirement lifestyle between 60 and 65 and defer your CPP at least to age 65. And when you turn 65, then obviously consider collecting CPP, or possibly, depending on your situation, you could defer your CPP all the way to age 70. If you have a substantial RSP, those 10 years will give you enough time to melt down that RSP and to reduce your overall tax bill and significantly reduce your estate tax liability. Because as we mentioned earlier, RSP or RIFs are tax deferred funds, meaning any withdrawal would be fully taxable. CPP coordination affects optimization, but the mandatory withdrawal mistake shows how RSP or RIF conversion timing can eliminate planning flexibility. As you probably know, you must convert your RSP to a RIF at the age of 71 or at the end of the year in which you turn 71. And then the following year in which you turn 72, you must start pulling funds out of that RIF, whether you need these funds to fund your retirement or not. So for most Canadians, we believe it's a mistake to wait to the age of 72 to start pulling funds out of your RIF. Let's look at a husband and wife situation where they're retiring early, retiring age 61, and both the husband and the wife, we're assuming, have about $500,000 in their RSP. So they have done well, $500,000 each, which is about $1 million combined in their RSPs age 61. Now, we're going to assume also they will make no further RSP contributions. But if the RSP portfolio is invested correctly and averages 7% per year from age 61 to age 71, the portfolio will double in those 10 years, meaning between the two of them, age 71, now they have $2 million in RSPs. 1 million husband, 1 million wife. It also means that the following year, age 72, they must pull out over $110,000 out of those RIFs, whether they need these funds or not. So because of poor planning, this is when most Canadians will be pushed into the OAS clawback territory, age 72, when they must start making these minimum withdrawals on an annual basis. And as I said earlier, that minimum increases as you get older. So instead of waiting until the age of 72, what they should have done was they should have gone into that RSP immediately right after retirement and start pulling funds out, not necessarily to fund their retirement lifestyle, but move those funds into your TFSA if the TFSA is maxed out, move those funds into a non-registered portfolio, giving you more flexibility later in life when your minimum withdrawals would be obviously reduced since your RSP market value would have been reduced. The comprehensive RSP withdrawal strategy that maximizes retirement income. So what should you do so you're as prepared or as efficient as possible transitioning into retirement? Well, first of all, you need to determine what your future retirement lifestyle will be and your cash flow needs. Then you need to plan for RSP or RIF withdrawals in lower tax years. You should be deferring CPP and OAS benefits as long as possible, if possible, or when possible. And the last fact really to be aware of is that you do not need to wait until the age of 71 to convert your RSP to a RIF. You can convert your RSP to a RIF prior to the age of 71. You can also convert partially, so you don't have to convert all of your RSP to a RIF prior to the age of 71. You could do half or 25% or whatever it might be. And you should be also aware of the fact that you can convert a RIF back to an RSP prior to the age of 71. So all of these flexibilities are available up to the age of 71. And probably the most important thing is that you should be contacting a local professional in your area to make sure you're as efficient as possible, to make sure your OAS will not be clawback in future years. We would be also happy to help, so please feel free to reach out. And let's look at a really quick case study. And this is an actual client family that we have helped transition into retirement. This is our planning software. On the left-hand side, you're looking at conventional wisdom. So deferring your RSP withdrawals to age 71 and 72. And as you can see in the early years, for first 10 years of retirement, this particular family is in a very low tax bracket and paying hardly any tax. But then when you notice the red line, that's the OAS clawback. And essentially, as soon as they hit age 72, their OAS is being clawed back for the rest of their life. So what we recommended is on the right-hand side, blended withdrawals, going into your RSPs immediately right after retirement and using those funds, not necessarily to fund your lifestyle, your retirement lifestyle, but moving those funds out of your RSP into a non-registered portfolio to reduce tax later in life. And for this particular family, all the other variables are constant. Same portfolio returns, same inflation, same spending, same retirement lifestyle. Everything else is constant. Tax deferral versus blended withdrawal, the difference is $565,000 at the age of 90. So this is significant. Tax planning is very, very important at any stage in life, but even more so transitioning or being in retirement already. Now that you understand the common RSP withdrawal mistakes that cost Canadian thousands, including poor timing, OAS clawback, CPP coordination errors, mandatory withdrawal traps, you can implement strategic withdrawal planning that maximizes your retirement income. If you want help developing a comprehensive RSP withdrawal strategy for your specific situation, click on the link below, and I will show you how to build your dream retirement in Canada. I'll see you in the next video.